For years, PlanB has been one of Bitcoin's most persistent long-term bulls. Through every drawdown, every macro shock, every cycle doubt, his message rarely wavered. That's why what he just posted matters. Because when someone who built their entire framework around long-term scarcity, stock-to-flow, and multi-cycle conviction finally says, "This is bear territory," the market should pay attention. Not because it means Bitcoin is dead, but because it forces us to ask a harder question. Is this actually a full-blown bear market? Or are we misreading a liquidity-driven breakdown that's hitting everything at once? Let's start with exactly what PlanB said. Bitcoin closed January at $78,635, 38% from all-time high. 200-week moving average $58,000. Realized price $55,000, decreasing. RSI dropped below 50, blue, official bear territory. Historically, Bitcoin could drop to 200-week moving average and realized price levels. However, bull has been weak, no red, so bear might be shallow. That single word, official, is doing a lot of work here. PlanB isn't calling for collapse. He isn't abandoning Bitcoin. What he's acknowledging is something more uncomfortable. The structure of this cycle has broken down relative to historical expectations. RSI below 50 has historically aligned with bear phases. The realized price is falling. Momentum has rolled over. And for the first time in years, even PlanB is openly admitting that a deeper retracement toward the 200-week moving average is within historical precedent. But notice the caveat. Bull has been weak, so bear might be shallow. That final line is the most important part of the tweet, and it explains everything about where we are right now. Before we dive in, if you value clear, no-nonsense crypto and macro analysis, the kind that cuts through narratives instead of chasing them, take a second to like this video and subscribe to the channel. It genuinely helps us reach more people who are trying to understand what's actually driving these markets, not just react to price. And if you're new here, make sure to check out our other videos as well. We regularly feature insightful analysis from some of the brightest minds in the industry. People who focus on liquidity, macro structure, and long-term fundamentals, not hype. If you're serious about building real long-term crypto wealth, then you need more than just an exchange. You need structure, security, and smart strategy. And that's where iTrustCapital stands out from the crowd. iTrustCapital is the platform designed for investors who want to grow their crypto tax-advantaged portfolio while having full control. With a self-directed Crypto IRA or their Premium Custody Account, PCA, you can invest in 80-plus top cryptocurrencies, physical gold and silver, and trade them all 24/7, seamlessly, safely, and simply. Here's why thousands of crypto investors are making the switch. Tax advantages that help you keep more of your gains working for you. 1% transaction fee and no monthly fees, cost-efficient wealth building. Institutional-grade custody that puts asset security first. 24/7 trading access to all supported assets. Multiple funding options, rollover, transfer, ACH, and even in-kind crypto transfers. Fast setup. You can sign up, fund, and start investing in minutes. And this part is important. iTrustCapital eliminates the slow, outdated, and overly complicated systems of traditional IRAs. No more paperwork headaches. No more friction. Just a clean, easy way to move your money into the assets you believe in most, safely and legally. And here's a great perk for getting started today. When you sign up using the link below and fund your new iTrustCapital account, you'll receive a $100 funding bonus. It's an easy boost to kick off your investing journey. Just use the link in the description to claim it. So if you want your crypto strategy to scale into something bigger, smarter, and built for the future, check out iTrustCapital through the link in the description. It's the platform designed for investors who want to grow, not just speculate. All right, let's get into it. When PlanB says the bull has been weak, he's pointing to something historically unusual. This cycle never delivered a true euphoric top. Bitcoin did make new all-time highs. It broke above $70,000 before the halving in 2024, something that had never happened in Bitcoin's history. But that strength never turned into mania. Even at the peak, Bitcoin only reached roughly $126,000, a level that, in prior cycles, would have been considered restrained, especially when you consider the backdrop. This was the first cycle with spot Bitcoin ETFs. Wall Street giants like BlackRock and Fidelity were onboarding capital. Corporate treasuries were accumulating. Bitcoin had regulatory legitimacy it never had before. And yet, no blow-off top, no parabolic final leg, no widespread retail euphoria, no speculative frenzy that usually marks the end of a true bull market. Instead of overheating, the market stalled. That's why this matters. Historically, deep bear markets follow excess, not restraint. They follow vertical moves, leverage explosions, and emotional peaks. This cycle skipped that phase entirely. So when PlanB says the bear might be shallow, he's acknowledging a structural reality. You can't unwind leverage that was never fully built. What we're seeing now isn't the collapse of a euphoric bubble. It's the grinding repricing of an underpowered bull that ran into a global liquidity vacuum before it could finish its move. And that brings us to Raoul Pal's latest analysis on crypto, macro, and the false narratives permeating the markets. Pal begins by writing, "The big narrative is that Bitcoin and crypto are broken. The cycle is over. It's all and we can't have nice things. It has dislocated from other assets. It's CZ's fault. It's BlackRock. It's whatever." It is an alluring narrative trap for sure, especially when we see prices puking each and every day. This is the most dangerous moment of every cycle. When price action becomes emotional, humans look for villains. They blame exchanges, institutions, ETFs, anything except macro plumbing. And Pal believes this is the exact direction from which we must seek answers to our desperate questions about what's really happening to crypto. Going further, he writes, "There is another factor at play that we have all missed. That factor is that U.S. liquidity has been held back due to the two shutdowns and issues with U.S. plumbing. The drain of the reverse repo was essentially completed in 2024. The Treasury General account rebuild in July and August, therefore had no monetary offset. The result was a drain in liquidity. That so far lackluster liquidity is the reason why the ISM has been so low." According to Pal's analysis, this is the core of the entire move. Liquidity didn't rotate. It disappeared. The reverse repo buffer is gone. The Treasury rebuilt cash balances. Shutdowns froze flows, and gold absorbed what little liquidity remained. There simply wasn't enough money to support long-duration assets like Bitcoin and crypto. Now, the US Gov is shut down. Again, the Treasury hedged this by not drawing down the TGA at all after the last shutdown, and in fact, added more to it, more liquidity drain. This is the current air pocket we are facing, and it's causing brutal price action. No liquidity for our beloved crypto yet. However, the signs are that this shutdown will get resolved this week, and that is the final liquidity hurdle out of the way. Quick pause for a second, because this is one of those moments where I'd really like to hear from you. Do you think this is genuinely a Bitcoin bear market? Or are we watching a liquidity-driven air pocket that's being mistaken for something worse? And if this breakdown is useful so far, smash the like button and subscribe to the channel. It tells the algorithm this kind of deep, macro-focused analysis is worth pushing, and it helps us keep bringing you insights from some of the sharpest minds in crypto and global markets. All right, back to Pal, because this next part is key. In his article, Pal also takes aim at what he calls a dangerous and widely misunderstood narrative around the Federal Reserve, specifically the idea that Kevin Warsh represents a hawkish shift in monetary policy. On the subject of rate cuts, there is another false narrative going around that Kevin Warsh is a hawk. It is utter nonsense. The key point Pal makes is that much of the commentary framing Warsh as a hawk is based on outdated remarks from nearly 2 decades ago, not on the reality of his current mandate or the political environment he would be operating in today. According to Pal, Warsh's real role isn't to tighten financial conditions, it's to execute a familiar playbook. Warsh's job and his mandate is to run the Greenspan-era playbook, he wrote. The Greenspan era wasn't about crushing inflation at all costs. It was about cutting rates, keeping liquidity flowing, and letting the economy run hot, while trusting productivity gains to suppress inflation pressures over time. Pal explains that this is exactly the framework now being discussed openly by Trump and Treasury Secretary Bessent, a return to a 1995 to 2000 style environment where growth is prioritized and inflation risks are managed indirectly rather than through aggressive tightening. It means cut rates and let the economy run hot, and assume the AI productivity rise will subdue core CPI, just like the 1995 to 2000 era. Powell also addresses another misconception, that Warsh would aggressively shrink the Fed's balance sheet. While Warsh may not be philosophically aligned with balance sheet expansion, Powell argues that the system no longer has the reserves to tolerate tightening. He is no fan of the balance sheet, but the system hit reserve constraints, so likelihood is he won't change its current course. He can't, or he blows up the lending markets. In other words, ideology doesn't matter when plumbing breaks. Powell's conclusion is clear and unambiguous. Warsh will cut rates and do nothing else. He will get out of the way of Trump and Besant, who will run liquidity via the banks. And crucially, Powell believes the process doesn't stop there. He points to regulatory levers, particularly the supplementary leverage ratio, or ESLR, as an additional liquidity accelerant. This matters because reducing the ESLR frees up bank balance sheets, allowing more lending, more leverage, and more liquidity creation, precisely the conditions risk assets like Bitcoin depend on. Powell ends the article by admitting wrongdoing in his previous analysis, leading to this point. Our mistake at GMI was not seeing the U.S. liquidity as the current driving factor, when it is usually global total liquidity that dominates over the full cycle. Powell explains that the market wasn't broken. Analysts simply underestimated how a rare confluence of events would temporarily override global liquidity signals. There is no disconnect. It's just that the confluence of events, reverse repo drained, TGA rebuild shutdown gold rally. Shutdown was not forecastable by us, or in any event we missed the impact. That sequence, not a failure of crypto fundamentals, is what caused the air pocket we're living through now. And crucially, Powell believes this phase is nearing its end. It is almost over, finally. Soon we can return to normal business. Despite these stumbling blocks, crypto fundamentals remain strong, a sentiment echoed by Bitwise CIO Matt Hougan in a recent interview, where he discussed Bitcoin's recent price action, crypto regulation, and how governments are slowly but surely beginning to show interest in crypto.
Yeah, look, we're extremely bullish long-term on where crypto is going, including through the end of this year. I think what we're working through, what I've realized after reflecting over the new year, is we were in a bear market in 2025. Many of the altcoins down 60+%. Bitcoin would have been down sharply if not for the huge buying by corporations and ETFs. So we're in the bottoming phase that comes at the end of a bear market. I think that's what we're seeing this year. We're seeing a little bit of capitulation on ETF flows, which have been weak. We still see retail sentiment pretty weak. I think we're at the rounding bottom part of the end of a bear market, and I'm pretty optimistic about where we go. I know it's looking rough out there today, but I still think the stars are aligned for a good 2026.
Well, where do we go?
Oh, well, look, I think my actual expectation is that we chop higher for a period. If you talk to long-term crypto investors, if you look at the skew in the options market, what you see is this pretty strong channel between about 75 and a little bit above 100,000. I still think there's a lot of Bitcoin for sale around that $100,000 mark. I think it would take us a lot to get through that. So for the first half of the year, I expect we sort of chop sideways in the channel. But as we continue to stack good news, if we get clarity passed, if people sort of better digest Warsh's apparent nomination to lead the Fed, I think we're going to eventually break out of this range, but I don't think it'll be Q1. I think this is a sideways market for a while as we round through the end of this bear market. But look, the fundamentals are really good. You're seeing transaction activity looking good. You're seeing app activity looking good. The case for Bitcoin as a store of value looks good. We will get there, but we have to chop through it for a while. More broadly, though, what the precious metals rally is telling you, not the last few weeks, but the last year, is that the world is worried about fiat currencies. The world is interested in self-custody. Those roads eventually lead to Bitcoin and crypto. I've been telling people when I go to institutional investors a year ago, I was telling them about Bitcoin being digital gold, and it was 10% of the gold market. And that's pretty substantial. And you had to convince them that it would go from 10% to 20% of the gold market. And they're thinking, this is a real thing, but that's a big leap. Now that the gold market is so much bigger, you're going in, we're saying we're 4 or 5% of the market. It's easy to imagine that doubling. So I do think when we get past this, when the momentum breaks, when the frenzy breaks, I think this move will be good for Bitcoin. But we do have to sort of get through the end of this momentum market. Yeah, well, eventually all roads lead to Bitcoin because it is a superior tool for what central banks are trying to achieve. The primary difference between Bitcoin and gold from a self custody perspective is that when you buy gold, you can self custody it while you hoard it. You can keep metals in vaults in your countries. But as soon as you want to use it, as soon as you want to pay for something, send it somewhere, balance trade, you lose that self custody. You rely on intermediaries. You have to put it on a train, a plane, a boat. You have to use a centralized vault that someone else controls. So gold is self custody while holding, but not while transacting. The difference with Bitcoin is that you get to self custody it all the way through to settlement, up to the moment that it transfers from you to someone else. You're in complete control and no one can hold it. So as central banks sort of mature in their understanding of Bitcoin, and as the world moves to where gold and hard currencies are used more for settling transactions, I think they're going to come to Bitcoin. Eventually, I think they'll own more Bitcoin than gold. How long will that take? These guys move on a glacial pace, right? You're talking about 10 years, you're talking about 20 years, but I do think the roads lead there. And I will say, we've already had meetings with central banks this year at Bitwise. So they are interested, they are studying, but they're early in their journey and they move slow. But make no mistake, eventually those roads lead to Bitcoin. Eventually, central banks will own more Bitcoin than they do gold because it is a simply better tool. Yeah, I've described clarity as the Puxatawny Phil of crypto. I think if we don't get clarity, this crypto winter sees its shadow, and we have like 6 more weeks of that winter. But the thing about that is, ultimately, to your point, we end up at the same place. So what clarity does is there cements the pro-crypto regulatory tilt in Washington, so we can count on it for years to come. If clarity passes, I think crypto investors will recognize and reward that by assuming that stablecoins and tokenization are basically fait accompli. If it doesn't pass, there's more uncertainty in that regulatory outlook. But as you said, the genie is already out of the bottle. There are already ETFs. BlackRock's most profitable ETF is now a crypto ETF. They're not going to turn anti-crypto. You have JP Morgan, you have Bank of America, you have Morgan Stanley building on crypto. They were not going to go back to the Gensler era rules. But I do think it changes the shape of the coming bull market. Again, if clarity passes, I think it's a fast market. If it doesn't pass, it's a slow market. But we end up in the same place, right? Stable coins and tokenization and ETF growth is not going to be denied, clarity or no clarity. It's just how fast do we get to where we're going?
I want to come back to what you were saying about central banks. Can you tell us a little bit about the questions central banks are asking about Bitcoin? And are you able to tell us what central banks you've been talking to?
I can't tell you which central banks I've been talking to, unfortunately, but they range in geography around the world and in size of country. So it's actually a relatively diverse list. They're still asking, to be honest, I wish I were saying they were asking implementation questions, size, liquidity, et cetera, custody. They're still asking very fundamental questions about Bitcoin. They're worried about existential risks. If you think of where institutional investors were in like 2018, when they asked sort of fundamental, what is this mining? How does it work? Why is it secure? What about quantum risk? Asking all the sort of FUD questions, that's where central banks are. That's a part of the process. So they're not anywhere near, I don't want to suggest in mass they're near allocating. You know they're near allocating when they want to talk about liquidity and custody and more implementation questions. We're not getting those questions. It's still fundamental questions, but the important thing is that they're asking them, right? 2 years ago, they were not asking them. Now they're asking them. Crypto adoption is a series of waves, and different people are at different points on those waves. Retail was the first wave. Financial advisors was the next one. Family offices was the next one. We're seeing endowments and insurance companies along. Central banks are probably the last and the largest wave. So they are coming, but it's still going to be a significant amount of time. That's just the speed at which these institutions work.
Unlike PlanB, Hugin believes this is the end of a bear phase in Bitcoin and crypto, not the start of a new one. ETF flows have weakened. Retail sentiment is exhausted. Price action is choppy, frustrating, and directionless. Exactly what you'd expect during a rounding bottom. Hugin's expectation isn't a V-shaped recovery but weeks or possibly even months of grinding chopping between roughly $75,000 and $100,000, while the market digests liquidity normalization, regulatory clarity, and macro realignment. So yes, PlanB is right to call this bear territory, but bear territory does not necessarily mean long, harsh winters and severe crashes. What we're watching isn't the failure of crypto. What we are watching is macro stress revealing where liquidity actually lives and where it temporarily vanished. Every major voice in this space is converging on the same conclusion. This drawdown was driven by broken liquidity mechanics, not broken fundamentals. And if crypto has taught us anything, it's that nothing stays broken for too long in these markets. If you want macro-first crypto analysis that doesn't chase narratives, doesn't sell hopium, and doesn't panic at the wrong moments, subscribe. Let's know your thoughts in the comments. What's next? A shallow bear market or a final shakeout before liquidity returns? Thanks for watching. And if you've been here through this chop, I appreciate you more than you know.